Hello, everyone, and welcome to the 2016 Finance Practice Symposium. We're delighted that you're here. Thank you very much for taking the time, and we're hopeful that you'll find tonight's event to be thoughtful and interesting. My name is Steve Kirsch. I'm a member of the faculty in the DMSB, and it's my pleasure to serve as the MC for tonight's event. Before we start with the formal event, I'd like to take a couple of minutes to thank the people that made this possible. So if you will, a large shout out for all the folks that really helped pull this together. First of all, on the administration side, Dean Courtney and Dean Trahan, who have been leaders in positioning our school with respect to innovation and the work that they have done to help us position us further, and FinTech being part of that. I'll add, as a faculty member, it was nice to get involved with an activity where there was virtually no pushback. They said, great idea, let's do this for everyone. So thanks to both Dean Courtney and Dean Trahan. Also, a great deal of thanks to Professor Bourne and Professor Gold, my colleagues. Professor Bourne is the chair of the finance group. We would not be here this evening if it was not Professor Bourne's idea to have a practice-focused symposium. During the last couple of months, he and I have exchanged numerous emails. He's provided a lot of ideas and suggestions and really helped pull this together. I'll add as well, as you enjoy the wine or the food, that comes out of Jeff's budget. So he's been very good to help us. I'd also like to thank my colleague, Professor Gold. She has been instrumental in pulling us together as well. She has provided a great deal of wisdom and insights and ideas as we worked to make this event a success. I'll add as well that it was very gracious of her. We're going to have some discussion tonight about emerging markets, international business and strategy, what's going on, particularly in regard to Bitcoin and blockchain. She was gracious enough to recognize we didn't have the time for it, and perhaps we'll cover that in a forum in the future. I'd also like to recognize Ann Benaware, who's standing back there. For those of us associated with the university, we already know about Ann's magic. The chairs, the great food, the wine, making all this come together. It's been a pleasure working with Ann, and she has really been just a wonderful resource. Finally, to the members of the panel who have been gracious to take the time to be here tonight to share with us their ideas and thoughts regarding FinTech. And I know personally I'm looking forward to what they have to say, and it should hopefully be an interesting evening. One other note, when you came in, we provided you with an index card. If during the event tonight in the first stage you have any questions that you'd like to submit to the panel, please fill out the index card, bring it in back. I will circle back and grab those. Obviously, we will not get through all of the questions tonight, but we'll get through some of them, and then we'll begin the process of, again, working with FinTech within the Northeastern community. So with that, we'd like to get started. Dean Courtney, please, with your opening remarks.
Well, thanks, Steve. And most of all, thank you all for being here today. I'm really excited about this event and want it to start. So let me just offer a few other ideas. Steve has already thanked the panelists, but let me say I'm particularly thankful for this group of panelists because, first, so many of them are Northeastern alumni or
Huskies.
Exactly. Lots of Huskies here, and or otherwise have a strong tie to the university, and thus are extraordinary role models of innovators in an emerging field that is really reshaping our economy in many ways. And to me, that's an epitome of a Northeastern alum. So we're really, really excited to have you here today. Besides Steve, he mentioned Jeff as a leader of the finance group, but the reality is the entire finance group has shown extraordinary growth and innovation on all dimensions in my time as a dean over the last 4 years. I've hired some really terrific new colleagues, developed a handful of new programs, and have accommodated a how many-fold increase in undergraduate concentrators in finance, Jeff?
We stopped counting.
Quite a few. And so I want to thank all my finance faculty colleagues here today. You're doing a tremendous job, and you're innovating and passing those innovation on to our students. Most importantly, I'm delighted to host this event today because it's not about the past. It's partially about the present, but it's a lot about the future. And obviously, every sector of the economy is being transformed by technology one way or another. We're living in very, very interesting times. But the financial services and management sector, and all you finance majors out there, you're not moving into the sector that existed 10 years ago, as far as I can tell, let alone when your parents perhaps were in the sector. And it's fascinating and it's fun, and the opportunities are enormous in this field. And that's what makes me excited as an educator, is an opportunity to learn from the best of practitioners in a way that perfectly complements what we're trying to do in the classroom. One thing I love about being a Northeastern is that we are committed to continuously tying the best in academic theory and traditional principles in fields, and tying it to the latest in practice. And we do that, of course, through our co-op model and through engagement in the community. But it's really important, if you really want to be on the cutting edge, is to both to have this sort of session where there's collaboration between cutting edge theorists and finance faculty and cutting edge finance practitioners. And that's what this is all about. So without further ado, let me just say I am proud and delighted to be with you all today, because I think it really exemplifies the best of a Northeastern education and the impact that our alumni are having on a field that is obviously going to transform our economy in the coming years. So let's get moving on it. Thank you. Welcome.
Okay, now going forward, we're going to follow a related two-step process. First, what will happen is that the members of the panel, beginning with Jay, will tell us a little bit about their backgrounds, some of the work they do, and specifically some of the work they do with FinTech. Following that, as we move down the line, and yeah, it is kind of long, but that again shows you like what Dean Courtney was talking about, the breadth of what we do here at Northeastern, and different roles and aspects with FinTech. But we'll move down the line, talk about different stages of FinTech. And then following that, we'll have a question and answer period. So again, get those index cards over to us if you have any questions. And one other note, in your brochure, you'll see a note for Michael Coles, a recent Northeastern grad. He was going to be talking to us about insurance as exemplified by this evening and by what Dean Courtney just said. Michael called me a couple of hours ago and said, hey, I just closed the first round of financing for my fund relating to insurance and innovation in insurance and FinTech. I'm not going to be able to make it. That's just fine. I sent him over to the alum office for donations, so we'll keep him going. But he was kind enough to have his colleague, Nikki, here, and she will be just as experienced in terms of explaining some things that they are doing. So with that, Jay, if you could please get started. And I'm just going to sit right here.
Great. Well, first of all, thanks to Steve for helping organize this, and to Extra who invited me, and really to everyone that could come out tonight. I think so from the private sector side where I spend my time, it's really exciting to visit the halls of academia and seeing how that those worlds come together, especially at a place like Northeastern. I unfortunately was not a Northeastern student. I'm not a Northeastern alum. I was a Tufts alum, so from the other side of the river, don't boo, please. But I'm excited to be here nonetheless. So I work for a venture capital firm called F Prime Capital Partners. It's a venture capital firm that's affiliated with Fidelity Investments, a large private asset management firm, brokerage firm. And we invest in basically across sectors, so diversified technology investing as well as healthcare investing. We have funds that are based in Boston, where I'm based, and then affiliate funds in London, Mumbai, Shanghai, Hong Kong, Tokyo, all investing in venture of some type, various sort of sectors and stages. It's a little bit that's sort of region specific, but all with the theme of where we can help great entrepreneurs build great companies. And we do it in a sort of deeply focused sector-oriented way. And so we have a FinTech practice that's a portion of what we do here in Boston, and that's where I spend my time. Within the FinTech world, we look at the FinTech world sort of in the most broad way you can look at it. So everything from companies in the banking world, companies in the lending world, capital markets, wealth management, payments, insurance, real estate, really anything where there's technology-enabled financial services is somewhere we invest. We make early stage investments. So our typical investment is a company that has a product in market, some early signs that the market's really receptive to the product, that things are working. There's a concept I can talk about called product market fit, where you feel the signs of just a product that is right for the market. And we also make that sort of Series B type profile investment where as a company that most functions are working. You have a sales cycle that you understand. You have a product that's pretty well built out, and you're investing capital for really scale and growth at that point. So I figured what would be useful to talk about here. I'll just talk very, very briefly about a couple of our most recent investments. I always think it's helpful to just talk about the practical, and then we can sort of find our theory from that. So some recent investments that we've made across different parts of the financial services landscape. We've made, so most recently we invested in an insurance company called Snapsheet, which does virtual claims estimating in the auto insurance world. So for anybody who's been in a car accident here and had a conversation with the insurance company where they said, look, I'm going to send an adjuster out to come see the car. They're going to look at it. They're going to write up an estimate, and then a week later you can get started on the process of either getting paid out in cash or going to get your car fixed in a body shop. What Snapsheet does is they took advantage of the fact that, look, everybody's got a smartphone in their pocket. Everybody's got a really high quality camera, and we can actually train people who've been in a car accident to take the right pictures at the right time of their car, and then submit those pictures to an estimator force to write an estimate of the damage and get that back to customers in a matter of hours. So from a car accident to either getting paid out, in the claim, or getting to take your car to a body shop, it goes from a week-long process down to a matter of hours, or, same day, next day kind of thing, which is a huge innovation. And it was an investment we made recently. It's a Series C investment, along with some other folks in Boston, Liberty Mutual Ventures, and a couple other folks. In the 401k side, we recently invested in a seed stage company, so an early stage company called Vestwell, which is based in New York, and took advantage of a couple of, we like to think of as sort of market discontinuities. So we were investors in a company called Future Advisor, which was a digital advisor or a robo-advisor that sold to BlackRock last year. And we learned a lot from that investment of both what works, driving, helping investors access low-cost investments with really slick tech and UI, and automated customer support, all of those elements that you need to make a consumer feel safe, interacting with it, really a technology to handle something that's really valuable to them and their money. And we also, from prior investments, understood that the financial advisor community has a role in advising people about where their assets are, and really is a helpful part of the ecosystem. Any company that's offering sort of wealth management services directly to the consumer faces the continual challenge of how do you acquire customers in a cost-effective way. And so as we looked at the 401k space, which is undergoing some regulatory change, the Department of Labor announced earlier this year a change to the fiduciary regulations where anybody that helps manage assets that are related to people's retirements, so 401k plans, IRA plans, now has a fiduciary responsibility to act in the client's best interests, which kind of sounds like something that would always be the case, but is now going to be the case as of next April. So as a result of that, a lot of the 401k plans that small businesses have, which is really an area where about half of small businesses offer a 401k plan at all, typically because they're very high cost, often offered by insurance companies that put customers in annuity-based plans that offer fees of 2 to 3% a year, which is a huge impact on your retirement savings. Vestwell says, look, the financial advisors need a way to protect themselves from this new liability that the government's putting on, this new responsibility. And small businesses need a low-cost way to offer a 401k to their employees. And employees are more likely to invest if the platform is easy to use, if it has a great interface, and if it makes things understandable. And so Vestwell delivers all three of those elements for all the stakeholders in the ecosystem in one nice, neat package. So the short of it is, we've been doing FinTech for a long time. We're investors in, Prosper in the marketplace lending world, Zoom in the payments world, Flywire here in Boston, and also in the payments world. We have about, 11 active portfolio companies in the FinTech space right now, and we're looking to make more. So excited to be here and happy to answer questions when we get there.
Hi, everyone. I'm Nikki Marshall, and just kind of mirroring what Jay said, really excited to be here. I know that Michael Coles kind of threw a curveball at Steve and the rest of the organizers in terms of sending me, but I'm excited to be here. And so I'm from a firm called Cedent, and we are a private investment firm investing purely in the insurance technology space, which is, a lot of you might not know, InsurTech, but it's a budding niche of the FinTech industry. And our main focus is what we like to say, not investing in the sexy companies, but investing in the companies that are going to have some kind of commercial application in the insurance industry in the long term. So if you think about companies like Guidewire, so finding a new technology company that does exactly what Guidewire does in terms of centralizing property and casualty insurers' applications, but into one place, and finding a way to do that in a more efficient manner that's going to allow an insurance company to underwrite more profitably as well as more efficiently. And we kind of have a few core focuses. One of them is on different emerging risks. So a lot of people say that insurance might be boring, but we actually think it's very interesting. When you think about, how do you insure a space satellite? How do you insure an autonomous vehicle? Who is the person that is actually the insured with an autonomous vehicle? Is it the person creating the technology? Is it the person who's actually providing the service? Is it the person that's implementing the software and the back-end application behind that? So these are some of the questions that we like to talk about on a daily basis. And in terms of my background, I came from an investment banking and private equity background, focusing purely on financial technology, and then kind of saw InsurTech as this really budding and interesting market. So I'm here to speak about InsurTech, and if anybody has any questions in that relation, then please feel free.
Great. Hi, everyone. Thanks so much for having me, Steve and Jeff and Hugh and the rest. George Overholser is my name. I think I am the dinosaur person on the panel to provide historical context. I got involved with FinTech really early. I was on the founding team at Capital One, and then I built, after 10 years there, I built a venture firm that focused a lot on FinTech investing. 1999 was when we first launched that firm. And then I went away for 10 years. And about a year and a half ago, I came back. I've been doing angel investing. And so what I'll love to talk about, and I'll spare you now, but is the difference. What a huge difference 10 years makes in the whole world of FinTech. And so be glad to share those thoughts. The other thing is we might get to, too, is I have spent the last 10 years doing a different type of FinTech, which is in the social space. Having to do with, I was the inventor of something that is called Pay for Success or Social Impact Bond. And that's a completely different world that if anyone's interested, we could also talk about how kind of a reinvention in the financing of social services is having some impact.
Good evening. My name is Brian Peralt. I'm a managing director and partner with Needham & Company, which is an investment bank headquartered in New York. I sit here in the Boston office. And we as a firm work with growth stage technology and healthcare companies on capital raising and M&A. So I'm here speaking on behalf of the perspective of working with boards and CEOs and CFOs on the process that they go through to realize value or raise primary capital for growth for their businesses. We have done a fair amount of work in the financial technology space. We've raised capital on behalf of companies like Bottom Line Technologies, if anybody knows Bottom Line in Portsmouth, and SS&C Technologies, and other software and payments related type companies. So I'm pleased to be here, and I'm also a Husky.
Cool.
Running away.
He's escaping.
Yeah, he didn't want to go. I'm one of the only Italian members of the panel here, so I tend to speak with my hands, and I was a bit muted on the table. Just for ease of use here, Chris Remonetti. I did the high-tech MBA program here at Northeastern. It really helped for my transition from engineering management to executive management and eventually into private equity. I manage a fund down, actually based out of Tampa, Florida. We are not regional based though, across North America and really global. And what we look at is, we think the model's broken right now for private equity and venture capital. So, they're really based on short-term focus. There's a lot of detrimental impacts right now that happen within private equity and social and economic kind of status at this point demand for a new model. So, it's part of the detriments. They're losing the best employees, the high cost of turnover, loss of knowledge, especially within technology space such as FinTech. This kind of kills the ability for a private equity to do a great deal of growth and innovation within the FinTech industry. So what we do at Prospequity is we kind of look beyond that. And we invest in two primary factions. One is we invest in people and communities, and then we invest in an ecosystem, a very systematic ecosystem of partners and strategic partners to be able to enable us the same resources as Blackstone, as a Bain, as someone with a very large kind of infrastructure administration staff. What we found what we found through some of our operational partners is that we can actually kind of sustain a better value out of this, a premium value, something that's sustainable over the course of time. So, as I mentioned, really investing in inspiring people and then infusing not just capital, but we look at kind of a systematic process. Just basics here of the power of investing in people. It ends up really increasing the productivity and bottom line of companies. Google's done a number of these, Johnson & Johnson. And you can by increasing employee happiness, you can increase productivity by over 37%. Same with community. You develop a great community reputation and you can really increase your top line growth. 55% of global consumers willing to pay more for products and services that believe in what they believe in. So how we do it within, call it an ecosystem of partners, we make it very systematic, and this is where it starts to get into FinTech. But we bring together this kind of the strategic ecosystem across a number of different sectors. Most of my partners were Fortune 500 leaders, former CFO of Coca-Cola, former managing director of Warburg Pincus, former executive vice president at GE for innovation, and we try to create a different model here. And then we use technology to bring it all together. So we have a couple of different technology stacks, but we use a proprietary system for essentially dashboards, intranets, and communities, bringing together not just call it the internal partnership, but the external partnership as well as the portfolio companies. So how do you manage the portfolio companies? How do you manage their services? And this is really where it gets into FinTech as one of the B2B, the B2C financing, the ability for companies to be able to process payments, to be able to process invoices, establish transfer pricing, establish hours worked and whatnot, all within one system where middle and lower middle market companies really couldn't access the right tools previously. So we kind of establish one systematic basis to do this internally, but also to do it across the portfolio of companies. Just a little bit about our opportunities. We look at high-tech consumer products, applied medicine, human performance, and then where it comes in, again, to FinTech, we invest B2B and B2C services. This significantly changed, obviously, with some of the Reg A Plus changes coming over the course of the last year and a half, as well as some of the emerging markets. It's just presented an enormous number of opportunities, both in, call it, energy leasing, energy servicing, the ability for crowdfundings, and the consolidation and fragmentation of that current market. So where does that come into play for us? Like I said, a number of areas. We run all of our back-end services through kind of these FinTech-enabled capabilities, but we also look at companies such as some of these other panel members, and how do we bring them to the next generation of FinTech? How do we establish this across the entirety of the industry? And what we're starting to find where the opportunity truly lies for us has actually been emerging markets and establishing the entire kind of vertical integration across what may be an emerging market, and that could be from the producer of energy to the infrastructure in between, and then the ability to actually process payments and kind of go beyond the existing currency models. Like I said, especially within emerging markets, but that's starting to bleed into the U.S. Across both the insurance companies, the insurance platforms within pet care, as I've spoken to a couple of the panels about, and eventually kind of medical and healthcare, kind of a dynamic use of algorithms and associated analytics to really derive pricing and what's going to happen over the next couple of years. So that's just a little bit about our firm and what we do with FinTech, and hand it over.
Hi, everyone. So I don't actually have a deck. I just felt like standing up. Yeah, sorry. So my name is Zach Sheffer. I actually graduated mechanical engineering May 2013 here from Northeastern. Go Huskies, come on. Yeah, right? Come on. So I guess when I was in college and in high school, I was really into personal trading. Unfortunately, I had basically no money, so I just started building my own applications, and I sort of wanted to formalize that education a little bit, so I went and worked at a company called Credit Suisse, which was, at the time, 5th largest investment bank in the world. Sort of went into it like, Credit Suisse, one of the largest investment banks in the world, probably doing pretty amazing stuff, right? No, not at all. Like, it was, from a technology perspective, especially going through engineering, it was almost scary how antiquated they were from a technology perspective. And as I continued, talking to other hedge funds, talking to other asset managers, like, that is the status quo. If you look at finance, financial services from a technology perspective, it's in many places decades behind where it really should be. It's in some ways, you really should be a little bit scared. So pretty much the day I left that job, I moved back to Boston and approached Justin, who's now the CTO of Elson, and he was actually studying computer engineering. So two Huskies on the anyway. Yeah. So his background is in the mass parallelization of applications using FPGAs and GPUs. Yeah, it makes programs really fast. Is basically what I eventually figured out after he told me a bunch of times. And that was really kind of how we wanted to start Elson. We knew we wanted to do something in financial services because it's like there's a lot of money in the world. Like, it's just everywhere. And it's really scary how antiquated these technologies were. So maybe there's some way that we can help investors create better strategies. We realized pretty quickly that both him and I had no idea how to actually create an application. The first person we showed it to said it looked like butt, which really was depressing. So we then actually brought on Ryan Johnson, who's our third co-founder. He has about 10, 12 years of UI, UX experience, basically actually making things look pretty. And we finally sort of nailed down on this idea of Elson. So we started Elson. I'm the CEO / janitor over at Elson. Thank you for working with me here. And so basically now what we do is we help asset managers create and test multi-factor models for their portfolios. So basically, we help them understand the risk-return profile of their strategies, as well as develop new strategies. If you really look at, again, asset managers, a huge amount of them are actually developing these things in Excel. Yeah, there's more data than ever before. There's easier ways for them to trade anywhere in the world, and they're trying to answer these questions in Excel. Like, the systems literally cannot keep up with the questions that they're asking. So we took our, very high-performance computing engine with a really pretty interface and basically started helping these asset managers do this. And now we're actually super excited because we're officially launching that product, which we've been working on for like 2 bloody years, actually with Thomson Reuters like this week, which we're pretty excited about. Yeah, so make lots of money. Great. Yeah, and so I guess through that entire experience, the couple of things that I really learned was we had this like hypothesis that all the really cool technology, like we developed our own language, it replaces like all of your SQL, it does all of your data alignment, like all these really cool technical things was going to be the thing that really people cared about, and not at all. Like it's the really simple things that we've done on the user interface side, actually developing these workflows and making them very simple, very intuitive. Like that was actually the thing that all the clients love. So they can basically, in a couple of minutes, answer 90% of the question, right? Like these guys have 100 other things that they're worrying about every single day. Like they just want to be able to answer something really quickly and not have to worry about all that other stuff. And one of the other interesting things that I think we've learned, because we kind of were doing some consumer stuff for a while, is that all of the, I guess, expectations that you're seeing on the consumer side are really starting to move over into the enterprise side. Jay said something really interesting earlier, which was, they need to, how do you make a consumer feel safe? And it's really the exact same thing on the enterprise side as well. Like portfolio managers are really just like scaredy cats. And how do you give them something that they don't have to worry about? They just log in, a couple of clicks, they've got their answer, and they can move forward. That was kind of what we wanted to do with Elson. Yeah. What else do you guys want to hear about? Yeah, so we're about 2.5 years old, 7 people, raised about 1.3 million so far, working on our next round of funding. That's Elson.
I'm gonna stand too.
Started a trend.
So my name's Extra, and yes, that actually is my real name. I get that question all the time, so I figured I'd start there. So I'm gonna tell you a little bit about what I do and what my background is to start, because it's kind of a combination of what everybody else has done so far. So first of all, are we going the right way? No. There we go. So first I worked in magazines. I designed a couple magazines, launched a couple fun motorcycle magazines. That was a good time. Got to ride motorcycles all the time. Some crazy ones with guys doing wheelies. Some other ones, guys for old people. Moved on to launching a couple startups. Buff Monster is an artist platform that sells consumer products for an artist. So we did anything from sourcing prints to making jewelry to a whole bunch of different stuff, and learned about building a business. Vanin was the second startup I helped launch. That was a watch company that's still in existence. They do watches based on bands and artists and TV shows, and they did the Dexter watch, and they do Iron Maiden and a whole bunch of other stuff. That was fun. Learned a ton about building companies and building finance departments and funding and all the usual fun stuff. Besides making any money. Then got a couple degrees. Went to UCLA for physics. Came to Northeastern. Came for 1 master's. Ended up getting 2. Not enough finance in the MBA, so I had to stay for more. Left that. Went to go work for a couple big banks. MUFG is the Mitsubishi United Financial Group, probably the biggest bank in the world you've never heard of. They're almost $3 trillion in assets, so they're right up there in the top 5, but no one has ever heard of them. Bank of Tokyo was a subsidiary that they own, which is actually the biggest bank in Japan, which tells you how big MUFG is if they own the biggest bank in Japan, and no one's ever heard of them. So spent a couple years there as a management consultant, working on some M&A projects and some other special stuff they needed to do. There were some divisions being merged, and there was a whole lot of changes going on because of the regulatory changes. So they had to set up a holding company, and there was a whole bunch of fun finance stuff to do. Learned all about banking, retail banking across the world, and international IB, because worked for a small IB firm within the group for a long time. And so yeah, spent about 5 years there. And while I was there, I got tired of working for banking, and so I started a startup. That was actually I actually didn't start it. It actually was in existence before I got there, but it was basically dormant and did nothing. The CEO had quit. All the employees had quit. The only reason it still existed was because after all the CEO and all the employees quit, it was awarded a patent, and so the company still technically existed. And so when I took it over, it was a patent and me. And this is what I've spent the last about 4 years working on. We're still not launched to the public. As it says here, we're a financial technology firm that combines a global payment platform with the precious metals market to create the world's first real-time asset-backed debit card. So what that really means in the short term is you all have debit cards in your pocket. They're all denominated by an account. They're linked to an account denominated in currency. But instead of attaching a debit card to a currency-denominated account, you could attach it to an asset-denominated account. So essentially what you need to do that is you need this. You need basically a payment platform that runs underneath it, that has an instantaneous exchange mechanism into it. So the way it really works is you come onto our site, you would buy some metals, you would go through a usual KYC, AML processing, just like you're opening up a bank account. Once you have a linked bank account, you would buy some metals from us. Usually it's gold and silver. That's what we're starting with, because those are the assets that have the most friction buying and selling them at the moment. And they're the ones that our customer base, which are gold and silver investors, have the most impact on. So you would come to our site, you would buy some metals from us. Those metals would be held securely in a foreign third-party vault. We wouldn't have any connection to them. This is fully vaulted ownership of where you have a claim to the gold and silver being held by those vaulting partners. So even if we disappear and we go away, you still have 100% access to all those assets. Connecting those assets to the financial platform is a debit card. So we've been working with a couple banks. We worked with a bank in the UK to do a public beta a couple years ago to actually test and make sure this worked. We're now working with a US bank here in New York. And so you'd get a debit card, and that debit card would essentially be attached to those metals. So whatever the current up to the second market value of those metals that you're owning is what you can spend. We're not extending any credit risk. We're not extending anything beyond what the current market value of the metals you own. So you'd get that card, and you could check on your app or on a phone what kind of value you had connected to that card, and then you could swipe to sell. So you could walk into any store in the world that accepts a Visa or MasterCard and use this card to essentially sell your assets instantaneously and have the currency from that exchange pay off your payment. So essentially, that's the key piece that we built in our payment platform, was the instantaneous exchange mechanism that goes flawlessly from currency to assets and assets to currency. So your merchant, where you walk into the store, anywhere that you're using a Visa or MasterCard, that merchant doesn't know what's backing up that card. They're getting a regular debit card, and they're accepting the payment from their merchant bank through our acquiring bank, from their acquiring bank through our issuing bank for the same funds that they would have gotten if you had used a card. There's only an instantaneous sub-second exchange between the assets that you have and the currency that we're exchanging. And so essentially what happens is a typical transaction would be you would go onto the website, you'd buy some gold or some silver, you would go into the store and you would spend that gold and silver as if it was cash, because the instantaneous exchange doesn't allow anybody to actually know what assets you have backing up. So we built this platform, and the patent we have is asset agnostic, so as we describe it. So it doesn't matter what your asset is. Anybody can come to us and say, I would rather own crude oil, or I'd rather own a different commodity, like copper, whatever they want. We can do any type of asset that's any kind of asset class that has the depth in the market in order for us to facilitate that. So who cares about this? Well, existing gold and silver buyers care. This is about a $1.6 trillion market. $1.6 billion market here in the U.S. It's about a $50 billion market per year in the world, and overall the gold market is about $2.5 trillion. So there is tons of depth and liquidity in this market for us to be able to always find a market that we can sell for 24/7. So essentially, what we're doing is what most fintech companies need to do, and that looks something like this, which is we have all these existing players in the market, right? And every market has existing players, no matter what market you're talking about. What we need to do is, and what fintech does is, you need to find an ability in an area of where the existing competitors don't have that market share. And you need to be able to provide a solution. The same thing with insurance tech or the peer-to-peer lending or any of the broad stroke kind of fintech areas you're in. You're trying to find a way of getting around what exists already and get into where you can create the most value added. And so for us, we have these 4 already large existing competitors in our market, types of competitors. And so what we did was we said, well, how can we add the convenience while not losing any of the liquidity, any of the other benefits that all these other people add? Because all of our customer base chooses one of these 4 competitors. And they don't pick it at one time or for one use. They pick it regularly depending on what they need. So if you need a high liquidity, you're going to go with an ETF, because that's the only place you can really get that type of liquidity. The problem is the ETF doesn't give you any type of redemption or any type of physical ownership. So it's essentially a paper product. So these solutions all exist in the marketplace already, but they all have some sort of limitations. So what we are trying to do is we're trying to look at the market and say, okay, where are the areas that we can make a benefit and we can move ourselves outside of all the competitors where nobody really exists. And really, I think to the bigger point about fintech is, to me, that's what attractive about it is you can find an area that's so entrenched. And I think you find this with banking and you find this with financial services, is that people use, and to Zach's point about how bad the technology is, you can find areas where you can move into an area and bring technology to it, which is essentially what we did. We brought this payment platform to the gold market, which never existed before. Because nobody ever considered the idea that you would ever have the ability to spend and buy gold and silver as seamlessly as we've created. And so essentially that's why XCard is meaningful to me and why fintech is what I'm into. And that's about it.
This stuff is so exciting, isn't it? Wow. Seeing this financial services and the insurance industry undergoing this, it's not revolutionary. It's certainly evolutionary. And as Dean Courtney said before, 5 years ago, it's different now. And future will be even more exciting. Well, we've gotten several questions for our panel, so if I could impose upon them to answer some of them. We'll begin with one question, which is, what talent do you think companies involved with fintech will want to hire? So let me repeat that. What talent do you think companies involved with fintech will want to hire? Anybody want to say something about that? Please.
Take that from an insurance
Thanks.
standpoint. So recently we were reading an interesting PwC report that said that 25% of individuals in the insurance industry are actually going to retire by 2018. So there's going to be this brain drain. And when you talk to incumbent insurers, they have this real interest in people that not only understand technology, but also understand from a project management standpoint how to implement that technology within the company. So I'd say that I think there's going to be this huge shift in terms of the kind of talent that these companies are looking for. They're going to be looking at people that have interactions with startup, people that have the technology experience, and people that have this focus on innovation rather than a focus on the traditional insurance or banking model.
Anyone else?
I was going to say there's an easy answer and then there's a sort of more complex answer. The easy answer is like every startup and large company, if you are a really talented software developer or UI UX designer, you could probably get a job at any financial services company, large or small, that you want. That's the easy answer. The more complex answer is I think there's a mentality that's really important for working in the fintech world. And it's one of, you know, a lot of what we've heard, especially from the startups that are on this panel, is there's a process of learning where in the fintech world, many of the best opportunities come from folks who are willing to go and learn everything they possibly can about their area of fintech. And I think we've heard a couple of great examples of that on this panel. All of the first level ideas, you know, the ideas that you can come up with, you know, just off the top of your head, all of them have been tried in some form or another, and some of them will get unlocked over time by really talented entrepreneurs. But many of the ideas that form really interesting opportunities for, especially for startups, but also for large companies, comes from people that just know more than anybody else has bothered to ever learn about a space. Whether that space is, you know, what is the process for buying and selling, you know, gold and silver, and how do we, you know, how could you do that in real time across exchanges, or whether that's what are the actual needs of asset managers, whether it's what are the specifics of, you know, what a payments industry, you know, self-regulatory body does and doesn't allow you to do around a certain payment type. Like the people that are willing to spend the time at the intellectual capital to get there, and then the creativity to take advantage of some of those nuances and, you know, in regulation and in terms of the way the market works, I think are poised to make a huge difference in the startup world or in large companies.
Thank you. Chris?
Wait, one thing to add to what Nikki mentioned here. There's an extraordinary transition in wealth happening right now, especially when you talk about many of our LPs are single-family office and multifamily office, and it's transferring from, call it a fifth-generation Rockefeller to a sixth-generation Rockefeller. And so especially when it comes to wealth management side of fintech, what's happening is 95% of the wealth managers are getting transitioned out upon that transition of wealth. So there's a millennial aspect that needs to be considered here, where there's a different mentality of investor, especially. So when it comes to resourcing and finding the right individuals to access, call it wealth management within fintech, you have to consider the kind of the new line of consumers and that transition of wealth.
If I could dovetail off of what Jay said a little bit, I think what he's speaking to, and I think what the reality is that it's much more about experience than it is about talent. With the exception of the software developers, I'm not sure that the talent is the point. I think the experience in the regulatory environment or the financial services environment, so you know what exists already and you know how to build on top of that, may be more important than any specific talent you might have.
I'll pile on that. One thing that makes financial services different than everything else is it is so regulatorily determined. And so you can't think your way through problems. You have to know your way through problems. You have to know the details, and the details do not necessarily make logical sense. And
the regulators don't make logical sense.
They make their own sense, but it is solid gold to have someone who has deeply, deeply studied how something truly works from the inside out. But I'll add one more too, which I think is very much a financial services skill, which is risk management. And it was just 8 years ago that everything melted down, and the reason it melted down was because there wasn't a risk culture that was pervasive. And in a lot of ways, you know, you're playing with fire when you're playing with large sums of money that you think are fully secured. You think you've done absolutely everything. But I'll share a short story about Capital One. The CEO, whose name, by the way, best named CEO of all time, Rich Fairbank, who's still the CEO there, incredibly, after all these years. He and I used to maintain a list of what we called the credit analysts. And these were the individuals who were permitted to set credit policy. And they were all incredibly smart and so forth. But you were not allowed to go on that list unless you had what we called a credit owie. Like, you had to have made an absolutely can't lose credit decision and nevertheless had it blow up in your face. And only then were you permitted to be on our list of credit decision makers, because there is absolutely a moral hazard in this world that you have to overcome. And so anyone who's hiring in this world, make sure you have credit, risk management people.
Thank you very much. All right, next question. And just following up on the regulatory issue, obviously very, very big. And if we have time, we have another question about regulations. But if we have some time, we'll get to it. Next question is, what areas of insurance are starting to see disruption, and what is a startup opportunity in that space?
So right now, I think in insurance, we're seeing a large focus on distribution, as well as the obvious using data and analytics to better understand the risk, as well as better underwrite the risk. So I'd say that currently that's kind of where InsurTech is. But that's not really where we think it's moving in the long term. So obviously, data and analytics are here to stay. But what insurance technology does for the insurance sector is it does something really interesting. It allows them to access demographics and markets that previously have no interaction with insurance. So if you think about, we're talking to a new company right now that is considering providing insurance, life insurance, to underserved markets within the United States for people that previously have never had any type of life insurance. And these insurance policies are basically going to be given to them through their cell phone policy and binded with that. So I think that's kind of where the opportunity is going, is allowing technology to make the value chain of insurance a lot more efficient, allowing it to, the end user to be people that haven't had the opportunity to interact with insurance before, as well as, the ability to underwrite more efficiently and understand the risk better. So I'd say that's probably where the main opportunity is. But right now it's at the beginning is distribution, and data and analytics are where we're seeing most of the companies.
Yeah, I could add a little bit to that, which is, some other areas. One, there's almost every significant line of insurance has at least one company who's focused on changing the nature of what that insurance is, and that has a distribution component, that has an underwriting component, and it has a customer experience component. There's companies, there's one in Boston called Quilt that's focused on changing the experience for renters insurance, where penetration is becoming, or purchase is becoming required for many tenants in both managed buildings and generally in apartment buildings. But the process for buying it has always been, really inefficient. The ownership experience has always been, basic and forgettable. It's a thing you see on your credit card statement or haven't paid, but it's not something that actually provides any value to you or helps you feel like part of a community. So that's just one example from the Boston area, but really every line of insurance has folks that are sort of rethinking it from the ground up, and what will come from that, I think, is one, a higher expectation of what the experience is for ownership, like I talked about, and then the second is these companies that are building insurance products largely from scratch, although typically with an external partner that's helping them just hold the actual risk. Every other function of an insurance company, whether it's claims management, whether it's policy servicing or billing, or even just all aspects of the actual buying process itself, are subject to some change due to new technology, and some of that is analytics, some of that is mobile technology like Snapsheet, which I talked about. Some of that is really just bringing their technology systems from first generation COBOL programming mainframe to cloud delivered SaaS-based services, and companies like Guidewire, which one of the co-founders based in Boston here, is a great example of bringing insurance into the 20th century, and I think there's now a great opportunity to bring every part of insurance into the 21st century.
Yeah, the one thing that I would say, interestingly, from my perspective is, not specifically in terms of sectors that are going to perform well or not, but more, in the 12 years I've worked in investment banking, a lot of the CEOs and board members that we've worked with have this propensity to kind of be eternally optimistic when selling these technologies into big banks and insurance carriers. And what I found is that it always takes a lot longer with these clients than they ever expect. So, we was talking with one of the panelists earlier before the event, and it was like, every year everyone says that electronic payments is going to take over paper checks in businesses, and every year it's like next year it's going to go away, and it's been that way for like 12 years. and there's $1 billion worth of infrastructure in the U.S. to support paper check processing. Now, clearly, it's not a growth market, but I think the point is that it takes a long time for banks, really risk-averse financial institutions, to implement change, and they have to really be persuaded that it makes sense and so forth. So when you find a company, an earlier stage company or growth stage company that has the ability to grow at growth rates well above what would seem like normal industry average growth rates, so maybe for enterprise software, if you're growing 30+% a year and you're selling to banks, there's something really extraordinary about the value you're adding at the margin for the customer with the business problem you're solving. And so in terms of unlocking value for shareholders, there's something really special about that company. So that's sort of one interesting observation that I would make, just in terms of this overall process of company formation.
Anyone else? Zach, I'm sure you have some war stories selling to banks and stuff.
Yeah, I mean, I think coming back to insurance specifically, the one that we always hear about is on the analytics side. And then I guess as all the other cool hardware stuff, like you mentioned, autonomous vehicles, or like drones, what's the insurance for a drone going to look like? That's going to be really cool. When you get your burrito and it hits someone. Yeah. So I think, it's going to be a lot of interesting stuff around all the new interesting hardware that's actually popping up, as well as all the analytics, because there's a lot of data with those things moving around, and how do you process that? It's going to be a lot.
Thank you. All right, next question from the group is, can you tell us a little bit about how FinTech is being used to transform the social sector? Let me repeat that question. Can you tell us a bit about how FinTech is being used to transform the social sector?
I think that one's got to be designed for me. I can just share a couple of things that I've worked on in the last 10 or 15 years briefly. One of them was to invent an equity-like accounting treatment and approach for high-performing nonprofits. There's no such thing as equity for nonprofits. And therefore, if you're trying to build a nonprofit firm, it's difficult to attract growth capital without having the people who gave you the money treat you as if they're customers that are trying to squeeze all the value out of the firm. And growth capital does the opposite. It protects the firms while others try to squeeze value from it. So I created a firm that had an equity accounting treatment for nonprofits, and incredibly, it changed behaviors. It was an innovation that brought in about, I think, $320 million of philanthropic investment into entrepreneurial nonprofits that protected those nonprofits until they were strong enough to fend for themselves at a much greater scale than they otherwise would have accomplished. I could never have done that if I didn't have a financial background. And so one of the messages I have for folks in their careers, whether you do it sooner or later, jumping from one sector to the next can be very valuable, because you learn things in one sector that you can then apply to the other. And then I'll briefly mention one other approach, which is called pay for success. And the concept here is, in the world of philanthropy and other forms of investment, it's people talk about the notion of social returns, but that's not a tangible thing. So how can you make it tangible? So we came up with an approach that I'll just describe using an example. We raised $18 million from a combination of philanthropists and Goldman Sachs. And we said, let's make it a loan for social purposes. And we're going to come up with a way that if we achieve the social purposes, your loan will be paid back plus interest to the extent that it's really successful. And the way we pulled this off is that we went to the state of Massachusetts and said, how about this? How about we'll figure out a way to reduce recidivism rates among gang-involved kids, which are currently at 60%. And we used our loan money to pay for a program that works with gang kids and brings the recidivism rate down to 20%. We then work with the government to pencil out how much that's worth to the government to have that many fewer nights. And in the end, the state of Massachusetts is paying us $100 per avoided prison night. over the course. This is a 6-year project. And to the extent that we are hitting our goals, which it looks so far, knock on wood, so far it's looking very good, we will get the money back from the government and in turn be able to pay back our philanthropic investors so that they can then recycle their philanthropy. So what we're trying to do is to create a feedback loop, a market feedback loop that's tied to something other than just wealth generation. In this case, you can call it societal wealth generation. That's called social impact bond or pay for success contracting.
Anyone else? Okay, next question. And this sort of touches on some of the topics we've talked about earlier this evening. What are some of the major challenges that you see going forward in FinTech? So perhaps it's regulations. A friend of mine who does research calls this the concrete middle, going into organizations and selling up into an organization. Is that the process? Is it changes in technologies? Is it global, or is it something else? Just kind of curious for our panel members on that one. Again, what are some of the major challenges that you see going forward in FinTech? Also, Brian, in terms of the investment banking side, some of the things that you might be seeing. So anyone, we can answer that, please.
Selling to asset management, selling to finance. Yeah, it's really hard. I think you kind of touched on it earlier. The sales cycle is just stupidly long. They need like every regulation in the book like hammered out. So I think that's actually one of the biggest issues that I guess the FinTech community, not just in Boston, but around the world is sort of facing, is that there's too many barriers to entry. Like if you look at it on the consumer side, there's a ton of really stupid, startups getting a bunch of money and then going and launching some stupid thing. Sorry, I shouldn't say it like that, but
we always feel that way about the other companies
like
when they raise the money.
Yeah.
They're stupid.
Well, I mean, they're just
how
like
can it be
doing
said
it
not
with
by our
ideas that,
company?
with like little to no validation that will almost never see revenue, but they're getting huge sums of money for some reason, and you really don't see that on the FinTech side. You're starting to see some stuff happening on the consumer side, but starting to see more of that on the enterprise side, I think will continue to be really valuable. Right, because we need to lower that sort of sales barrier, get more startups access to large partners. Because if they can get those proof of concepts, if they can get those statements of work in, right, that's the initial pieces of validation to help them continue to grow. So that's I think the largest barrier that we face is just selling to large enterprise firms with all the regulations, with all the barriers that are sort of in place.
Sounds almost like a marathon, just sort of knock down, drag out through the desert.
Yeah.
No water. So,
Yeah. Well, yeah, it sucks.
It's very nice to be on the other side of that barrier.
Yeah. 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 It's great kind of after you've gotten through it, or if you're on the other side, that'd be nice.
Extra, your thoughts, because you've had some issues with.
I would definitely.
Capital and.
Yeah,
how
I would
hard it's
definitely
been.
agree with Zach. The process is very difficult to sell to the big banks. I mean, even someone who worked at a big bank, I thought that I would have a little more insight into what their process would look like or what the regulatory requirements were that Zach mentioned. But I think almost more importantly, it's almost the mentality of it. The big banks have this mentality of they know what's going on. They're in these lines of business. And if you bring them a different idea or a new line of business, it just doesn't fit with them. It's incongruent to what they know about banking. And there's a certain amount of ego to this that feeds into this mentality, but it's very difficult to not only go through the process, but if you're trying to bring them something that's new and different. I negotiated with a big bank for 11 months. We had a signed contract. We were a week away from launching, and the VP called me and said, we're just not going to do it. Wouldn't give me an explanation. I eventually got one that was unsatisfactory. But there is so much power on that side that they can go, I don't care that we have a signed contract. Sue me. What are you going to do about it? You don't have the money or the resources to come after me and do anything about it. So it's a very, I guess what Zach was probably referring to is a very one-sided relationship. And it becomes difficult, even though there's all these press releases and all this media hype about FinTech, to actually have that conversation and convince the person sitting across from you as an SVP at a bank to say, this is why it makes sense. This is why our customers want it. This is why you've never done it before. So I think that's probably like an overarching challenge, more than the regulations or those, because you can get through the regulations. You can eventually learn them. You can say, listen, we've done this, we've done that. We put in this AML processing. We did this scanning. We did microprocessing. Whatever it takes to get around it, you can do it.
Yeah.
The mentality is much more difficult to overcome.
I guess I might argue almost the flip side
Fair enough.
of that, which is, I remember, years ago, why did we choose the credit card industry at Capital One? And our phrase was, we wanted to compete downstream from the head-to-head technology wars. So what? We wanted to compete downstream from the head-to-head technology wars because if we were going to do the hard work of starting a company, we didn't want someone to leapfrog us right away. And the harder it is to get into a business, the more long-lived that business will be, all else held equal, because
If you get in.
because if you get in. Right. So it's really tough being an entrepreneur, but the worst thing is, I think, being in a food fight with a whole bunch of other well-financed folks who who can just jump right in on you. But I am concerned about two things that I'm seeing. I'm Rip Van Winkle. I went away for 10 years and I came back, and the world is entirely different in FinTech from when I was there. And the two main differences that I'm seeing is, first, there's so much money sloshing around that the valuations are crazy. I mean, particularly West Coast valuations. There are, I'm in a couple of FinTech firms now that it's nice because now the people from the West Coast are coming offering absurd money to buy these things. It just makes me think the whole thing is going to blow up. And I really would not want to be running a fund, particularly on the West Coast or anywhere, because you're competing against folks who are potentially going to overpay. And then the other thing I would say that's very different is that it is a great thing for society, but it makes it tougher to invest. For instance, I invested in a company a year ago that, from a standing start, built up something which is now a fully scalable, absolutely industrial strength company with great technology. And it's all because the cloud, basically. And the fact that we were able to go to Vistaprint, where I used to be a board member, and we got the technology team from Vistaprint, and then we got some people from Capital One who understood. This is a business, by the way, that is making it possible for large companies to offer student loan pay down as an employee benefit. It's a great idea. It's a $1 trillion market. It's bigger than the credit card and auto loan industries combined. It took, in the course of a year, they built a fully scalable company. So you have these super compressed cycles that make timing everything. And if you miss a beat on the timing, if you have the bad luck to just be 2 weeks late on something, even it can go that fast, your whole investment can be a washout for you. So it becomes more luck, therefore, and less skill, in the end, unless you want to call the ability to execute very quickly skill, which it is, but it's a different, it is definitely a different environment.
Jay?
This is the part of the panel where we convince everybody that FinTech is like way too hard and you shouldn't do it.
We start
so-
saying how wonderful it is, and then you go home feeling
Yeah, exactly.
differently.
So I will pile on to that. And say, no, so from the consumer side, we talked a lot about the B2B side. And the consumer side of FinTech, one of the consistent challenges is, so I have a lot of friends who work in venture, in other sectors, and they talk a lot about things that I rarely talk about. So they talk about viral coefficients. When a consumer downloads an app or gets a new service, like how many people do they tell, and how long does it take for them to tell them, and how many people then download the app, and with very, very few exceptions, like that doesn't happen in FinTech, and especially that doesn't happen for FinTech companies that are generate real revenue from their primary product, and it's because look, how many of you are going to be so excited that you're going to tell your friends after this, or your husband, wife, whatever, like, oh my gosh, like I learned about this really new insurance product today, and like I am so excited to tell you about it. Like there's this
I might,
like
actually, but
there's this home loan that like the way they do it is so like there's huge innovations going on, but like getting customers to pay attention and to care and to understand something that like so we're all like financial services nerds here, like in this room. Like we love this, like, oh my gosh, you created different sub limits on your policy, the different things, like that's awesome. But unless you're getting the customer to really unless they already really feel the pain, or you're willing to go into the really hard business, something that Capital One did really well of like hyper targeting people exactly when they are in the market to purchase to use a financial service or a financial product. You're going to be challenged in getting just the attention share from the consumer, and so that's a challenge that is true across all of the consumer facing fintech applications.
I'll just add on to that from a kind of commercial standpoint. I'd say it's kind of the same thing in the commercial setting. One of the biggest things we see is, there's no lack of capital, there's no lack of great ideas, but when it comes to actually physically implementing that idea, that's where all the challenges arise. So if you have this great startup, it's doing, really awesome stuff, how do you convince a huge insurance company that's been around for 100 years, first of all, that they need that change, second of all, that it's worth their capital, and third, that they should spend all of this time actually, hiring consultants to implement. And then within the companies, everybody is, averse to change. So I'd say that's the biggest challenge from a commercial standpoint, is just actually implementing the ideas and getting that across the finish line. Like Extra mentioned, 11 months doing the diligence with the company, and then last minute they decide they're not going to do it anymore. So just so you said, convincing the consumers, it's convincing companies that they need this technology. There's actually going to be some kind of substantial long-term benefit to them.
Just to add on the other side of this, there's, with so much accessibility to capital out there, there's a lot of niche solutions popping up all over the place. And what happens is they get developed on all of these different platforms, addressing all of these different niches. In the B2B services alone, there's 100 different B2B services in Western Canada that you have to deal with, even in the Fortune 1000 level. So there's two areas to consider with this. One, as George mentioned, it's a bit of an accelerated technology cycle. So you're seeing kind of the rise and fall very quickly, the failings of some of these technologies. With the insurance side, you're going to see a lot of algorithms pop up where the cost of insurance for a drone starts out at $1,000 and it's going to be $10 2 weeks from now. But on the other side, they're being built on all of these different platforms, and cybersecurity is becoming a major issue because the regulations aren't really standard across all of these different sectors because they're popping up in these niches. And it's becoming an access point where, areas like Extra's focused in, where there may or may not be fully regulated by the standard set of cybersecurity regulations. And that's becoming a major concern, especially from institutional investment standpoint.
Other comments or questions? Well, we're at just about 7:30, and we're going to call it now. Feel free to come up and speak with any of the panel members if you'd like. Thank you all for coming. Thank you all for the panel for what they did for us.